What if I told you that the biggest reason most people lose money in the stock market isn't because they pick bad stocks? It's because they don't manage risk. Many beginners spend hours searching for the next winning stock, the perfect trading strategy, or the next hot market trend. But very few spend time learning how to protect their money. And here's the reality. You can be right about the market and still lose money if your risk management is poor. On the other hand, you can be wrong many times and still make money if your risk management is strong. In this video, we'll discuss the importance of risk management for both investors and traders, look at real numerical examples, and understand how professionals survive and thrive in the stock market. What is risk management? Risk management is the process of controlling potential losses while maximizing long-term returns. Think of it like wearing a seatbelt while driving. A seatbelt doesn't prevent accidents, but it protects you when something goes wrong. Similarly, risk management doesn't guarantee profits, but it prevents a single mistake from destroying your portfolio. The first rule of investing is simple: never lose so much money that you can't recover. The mathematics of losing money here is a fact every market participant should know. Losses require larger gains to recover. Lose 10%, need 11.1% gain to recover, lose 20%. Need 25% gain to recover, lose 30%, need 42.9% gain to recover, lose 50%, right arrow need 100% gain to recover, lose 75%. Need 300% gain to recover. The deeper the loss, the harder the recovery. That's why protecting capital should always be the first priority. Part 1. Risk management for investors. Long-term investors often believe they don't need risk management because they're holding stocks for many years. That's a dangerous assumption. Even great companies can experience significant declines. Consider this example. Suppose you have $100,000 and invest all of it in a single stock. If that stock falls by 50%, your portfolio drops to $50,000. Now here's the problem. To recover from a 50% loss, you need a 100% gain. Many investors underestimate how difficult recovery becomes after large losses. Diversification, one of the most powerful risk management tools for investors, is diversification. Instead of investing all $100,000 into one company, imagine investing $20,000 in technology, $20,000 in healthcare, $20,000 in consumer goods, $20,000 in financial services, $20,000 in energy. Now, even if one sector suffers a major decline, the damage to your overall portfolio is limited. Diversification doesn't eliminate risk, but it reduces the impact of any single mistake. Margin of safety. Great investors also use a concept called margin of safety. Suppose your analysis suggests a company is worth $100 per share. Instead of buying at $100, you wait until it trades at $80 or $70. This discount provides protection if your analysis is slightly wrong. Legendary investor Benjamin Graham considered margin of safety one of the most important principles of investing. Position sizing. Another important concept is position sizing. Imagine you discover a company that you strongly believe will perform well. Should you invest your entire portfolio? Probably not. Professional investors often limit individual positions to 5% to 10% of their portfolio. For example, portfolio size, $100,000 maximum position size, 10% investment in one stock, $10,000. Even if the stock drops 50%, your total portfolio loss would only be 5%. That's manageable. Part 2. Risk management for traders. Now let's talk about traders. For traders, Risk management is even more critical because they take frequent positions and face constant market volatility. Professional traders don't focus on how much they can make. They focus on how much they can lose. The 1% risk rule, a common rule among professional traders, is risking only 1% of trading capital on any single trade. Let's say a trader has a $10,000 account. Using the 1% rule, maximum risk per trade equals $100 no matter how confident the trader feels. They will not lose more than $100 on a single trade. This protects the account from catastrophic losses. Example of position sizing: suppose a stock is trading at $50. The trader decides to place a stop loss at $48. Risk per share: $50, $48 equals $2 maximum risk allowed. $100 position size: $100, $2 equals 50 shares, so the trader buys 50 shares. If the trade fails, the loss remains limited to approximately $100. This is professional risk management in action. Why stop losses matter: many traders refuse to use stop losses. They hope losing positions will eventually recover. Unfortunately, hope is not a strategy. Imagine buying a stock at $100. The stock falls to $90, $80, $70, $60 without a stop loss. A small mistake can become a devastating loss. A stop loss acts as an emergency exit. It allows traders to accept a small loss before it becomes a large one. Risk-reward ratio: another key concept is risk versus reward. Professional traders often look for setups with at least a 1-2 or 1-3 risk-reward ratio. For example, risk: $100, potential reward $300. This creates a 1-3 ratio. Now imagine taking 10 trades, winning only 4 trades. 4 winners times $300 equals $1,206. Losers times $100 equals $600 net profit, $600. Notice something important. The trader was wrong 60% of the time, but still made money. This is the power of proper risk management. Common risk management mistakes. Let's look at some mistakes that destroy portfolios. Mistake 1. Investing too much in one stock. Many investors become emotionally attached to a company and put most of their money into it. If the investment thesis fails, the portfolio suffers severe damage. Mistake 2. No stop loss. Many traders hold losing positions indefinitely, hoping the market will reverse. Sometimes it does. Many times it doesn't. Mistake 3. Using excessive leverage. Leverage magnifies gains, but it also magnifies losses. A 10% market move against a highly leveraged position can wipe out an account. Mistake 4. Ignoring position size. Even a great strategy can fail if position sizes are too large. Risk should always be calculated before entering a trade. Final thoughts: most beginners focus on making money. Professionals focus on protecting money. The stock market rewards those who survive long enough to let compounding work in their favor. Whether you're an investor holding stocks for years or a trader taking positions every day, risk management is not optional. Diversify your investments. Control your position sizes. Use stop losses when trading. Never risk more than you can afford to lose. Because in the stock market, success isn't about winning every trade or every investment. It's about staying in the game long enough for the odds to work in your favor. If you found this video helpful, don't forget to like, subscribe, and share it with someone who wants to become a smarter investor or trader. Thanks for watching, and I'll see you in the next video.